misnomer that the dollar is strengthening. It's actually down 4, 5, 6% over the last couple months, and maybe 0.5% off of its bottom. View what's going on right now very similar to what they were doing during that 17 straight down days in a row. I mean, I think this is paper shenanigans.
A rare situation is allowing you to buy some ETF stocks for 50% off. Learn more at crushthestreet.com/profit2017.
Hello everyone, and welcome in to crushthestreet.com. We got a dynamic guest on the line today, precious metals expert, economic expert. He's Bill Holter of jsmindset.com. He's been on the show before, and we're going to discuss what you're all wondering about. And let's talk about precious metals. Gold's at around $12.45 last I checked, and silver is at about $16.40. Bill Holter, thanks for coming on the line with me today.
Thanks for having me again, Kenneth.
Bill, what we are seeing right now with gold, is it simply a matter of the dollar getting stronger with the Fed tightening and raising interest rates and pounding gold down? One thing I would point out, which I guess has been good since they started raising interest rate, is rate hike to rate hike, we've actually seen gold go up consistently, even in the attempt for the Fed to tighten down monetary policy towards a strong dollar situation. So let's just get your thoughts on where we are with gold and silver here.
Well, the dollar really has not strengthened much. It's strengthened about 0.5%. So that's kind of a misnomer that the dollar is strengthening. It's actually down 4, 5, 6% over the last couple months, and maybe 0.5% off of its bottom. I view what's going on right now very similar to what they were doing during that 17 straight down days in a row. I mean, I think this is paper shenanigans.
Well, we seem to be in a situation right now where the Fed is causing interest rates to, or the yield curve is flattening out. And we know in the past, policymakers have ignored this when the yield curve has flattened out and even inverted. We haven't seen the yield curve this flat since 2007, right before the 2008 crisis. And is this important to you in terms of what we can expect in the economy?
Well, yeah, it's important to me. It should be important to everyone. If you go back and look at the yield curve over the last, even over the last 100 years, you can see that in the U.S., we have had recessions in the past where the yield curve was not inverted. But every single time that the yield curve inverted, we had a recession follow that. And I think something that's really being missed is China's yield curve is inverted. And China has stoked up on credit tremendously over the last 5, 6, 8 years. So an inverted yield curve, just think back to the 1980s when they were lending long and borrowing short, and the cost to borrow short became greater than what they were receiving on the long end on the investment side, and that bankrupted a lot of entities. It popped the savings and loan bubble.
So then what's the significance of what we're seeing in China? If they're already in a situation with an inverted yield curve and all the debt that they've taken on, what do you suspect are they in for versus, let's say, the U.S.? Is it much bigger problem there?
Well, let's put it this way. It's a newer problem to them because, if you go back 50 years ago or even less than that, they were strictly a command economy. So they didn't allow market forces to work. But now you've got a situation, actually what the Fed did with their tightening in the past, the Central Bank of China has generally followed whatever the Fed did. And the problem now is that there has been for the last year or 2 years, there's been a capital outflow from China that they're trying to stop. And This time around, as of this morning, I don't think they've matched the Fed's rate increase. So that's going to exacerbate the capital outflow. Then on the other hand, the Fed tightening is acting, if you will, to invert China's yield curve further. And an inverted yield curve on top of a highly indebted system is a bad thing. So it's, I wrote a piece last week, China's Dilemma, and really the movement from the Fed has direct ramifications on China's financial markets.
So then when it comes to the yield curve, who's being spooked? Because that's an indication of we are worried about the future. So short-term interest rates go above long-term ones. So where exactly is the quote-unquote panic taking place? And, just some thoughts on that.
Well, what you're seeing is theoretically higher short-term interest rates is going to slow the economy down. Slowing the economy down, and especially with an indebted system the way we have, people are worried about defaults. They're worried about deflation. So what they're doing is the capital is flowing into long-term bonds, and you've got the short end that's rising and the long end that's staying the same or actually dropping in yield. I look at it as it's truly the wrong move, because in the end, all of these fiat currencies are going to blow up. And when the fiat currencies blow up, you're going to see interest rates across the board everywhere skyrocket. And that's a function of investors will finally look at, hey, I'm putting X amount of dollars or yuan or euros or whatever into bonds, but when I get paid back in the future, those payments are going to be worth less because the currencies are worth less.
Right. Well, that's exactly what we're seeing. But it would appear that the banks are winning in terms of their objectives to maintain and keep the gold and silver price down. How much longer can banks, namely JP Morgan, continue to manipulate and suppress gold and silver down? And I know many are feeling the exhaustion of seeing gold and silver rise and for it ultimately to be slammed down once again.
Well, I've said for quite a while, they'll be able to maintain the suppression scheme until one of two things happens. Either the rule of law takes over, in other words, the CFTC, et cetera, SEC, come in and say, this is illegal. But more than likely what's going to happen is, and in my opinion, this is highly likely, is somebody's going to not be delivered on. In other words, they make a fairly large purchase and delivery can't be made. And we know that that's going to happen because if you add up the demand, the global demand, which is 4,000 tons, 4,500 tons per year, and you match that with supply, which if you take China's production out, it's under 2,500 tons per year. We've had a 1,500 to 2,000 ton shortfall for 10 or 15 years. And that gold has had to have come from somewhere. And the only somewhere that on the planet has got to be from Western vaults. So the question is how much gold remains.
Bill, I guess when it comes to just people's, buying gold and silver, what is your advice for these people who are getting, tired of waiting? Do you have any sort of encouragement towards them?
Well, they're not buying gold or silver. They're saving in gold and silver.
Got it.
And the bottom line is use gold and silver as your bank account. Because when the system collapses, you're going to have wealth as opposed to your wealth being wiped out.
Well, I'd like to get your thoughts on Bitcoin, because this has been a big detractor from a lot of precious metals investors. And many are seeing what can happen to an asset class that is not being manipulated. And Bitcoin started in the depths of the 2008 financial crisis. Satoshi Nakamoto came out with this concept, and he put Bitcoin out, and it's taken off. You know, the ability to transfer wealth across borders instantly, a store of value, limited in quantity. I know there's a lot of controversy out there whether or not it's a true sound money system, but it sure is telling to see what is going on and the competition that it is for fiat currencies. So I just would love to get your thoughts on Bitcoin here and what we're seeing right now.
Well, in a sense, digital currency is just another fiat currency. You're saying Bitcoin, but there's probably what?
Almost 1,000
or more cryptocurrencies, and there could be 1,000, there could be 100,000 new cryptocurrencies in the future. So to say that the quantity is limited, we don't know that, because there could be more and more and more cryptocurrencies out there. I would just question, really, what is Bitcoin? I mentioned this on an interview a week and a half ago. I went into get some feed for my horse in a local feed store. The little town looks like the 1950s, and in the event of the system coming down, I'm sure these people don't even know what Bitcoin is. Mm-hmm. But if I went in with a 1964 or earlier silver quarter or dimes or whatever, they would take them right now. So I'm not a big fan of Bitcoin. I'm not a big fan of digital currency. I do believe that ultimately that's what these central banks are looking to do, is a one world currency, and it'll be a cryptocurrency. Which cryptocurrency it is, I have no idea. But my guess is, unless it's backed by gold, it's just going to be another dollar or pound or euro or whatever you want to call it. I think Bitcoin is a trade. You've seen, you've seen tremendous volatility. You've seen it rise parabolically. I just question what value is it going to have when the music stops, and the music is going to stop.
Well, Bill, I'm wondering if you think that we could very well see precious metals move in the way Bitcoin has, because that move, I think, showed many of us what it's like to potentially miss the boat. Because after it's been going up, I've been getting emails and text messages and comments saying, I want to get in, but I'm waiting for a pullback. And it just keeps going higher, higher, and higher. And then people end up buying at a much higher price. And, God forbid it gets cut in half. I have a feeling that there's a day coming where precious metals are going to do that very same thing. And it's going to be hard for people to pull the trigger at 1,500 because they just saw it at 1,200, and then it's going to go to 2,000, and they're like, oh, I wish I bought at 1,500, and that whole cycle is going to happen again. And I guess what I'm saying is you want to be on this train before it leaves the station. Any thoughts on that?
Yeah, that's what you're talking about is a micro view. You're talking about, it goes to 1,500 or goes to 2,000. The macro view of it is, we have a derivatives event, we have a credit event, credit shuts down, markets shut down, and there will not be a price for gold or for silver. You won't be able to buy it, no matter how badly you want it. So that's being shut out of the market, physically shut out of the market, and I can see that day coming.
Yeah, that's a good point. That's even more extreme than we've seen even with Bitcoin. But
right.
I
so
think
either you have it or you don't.
Right.
And it really doesn't matter what you pay for it, because going into the next system, that's how you're going to transfer your wealth from this system to the next system, in my opinion.
Many are saying that the banks are hoarding precious metals. They have it in their custody, and they have it in their vaults, and they're preparing for a potential implosion of the derivatives, the paper market, Ponzi scheme. Any insight on this from your end?
That wouldn't be surprising, but I don't have any evidence to support saying, yes, that's what's happening, or no, that's not what's happening.
It's interesting.
But it would make sense. My partner, Jim Sinclair, back in the late 70s and up till, February, March of 1980, he said that up until 1978 or so, the banks were leaning against gold. And then by the time late 1978, early 1979 came around, the banks were the ones who made the most money because they flipped their short position, got long, and they blew it to the moon.
Yeah, that's interesting. I find it hard to believe that these people, these bankers, are going to be the ones in the end that are screwed, even when the whole system implodes on itself. It just seems to always work out for those in power.
Well, they are the owners of debt. And when I say the owners of debt, I'm talking about, debt on home mortgages, on farmland, on commercial, industrial real estate. And if you go back to Weimar Germany, you'll see that when they went into hyperinflation, those contracts, the loans were rewritten into gold loans priced before the hyperinflation took off. So the banks actually did save themselves. They ended up owning a good percentage of real estate, of productive capacity, etc., because the loans couldn't be paid back because they were rewritten in gold. And that's a potential. I think that's very possible that you see that again. But this time around, you did not have the derivatives back then that you have now. And this time around, you're talking about a derivatives chain that is so big, it very well could wipe out central banks included.
Wow. Well,
you're talking about over $1 quadrillion worth of derivatives. And the argument is, that's all notional value. But the bottom line is notional value in a default scenario becomes full value.
Bill, is there any way that central banks can take their manipulative powers or capabilities to the next level to continue to manage what seems to be getting out of control? Do they have more ammo to throw at the system?
I don't think so, because if you look at the real economy, you can see the real economy is fading all across the world. Just look at trade. Trade is your key to that. They can't manipulate the trade numbers, and the trade numbers are down 10, 12, 14% year over year. Trade is definitely shrinking. GDP is shrinking. And literally the only tool that they're going to have left is to print more. And the bottom line with printing more is it dilutes the value of the currencies. So your question, the answer to it is the result will be hyperinflation or worthless currencies, whatever, it's one and the same.
Sure. All right, Bill. Well, hey, I appreciate your time here on Crush the Street. If people want to learn more about what you do, please let them know about JS Mindset.
Yeah, you can go to www.jsmindset.com. It's a twofold site. We put articles of interest up and put comments to that, and then my writings, and Jim writes some, and we do a weekly interview, just a cross interview between Jim and I, and occasionally we have a special guest on. We do that for subscribers, so I would urge people, if you want to see our work and follow our thoughts, subscribe. And actually, you can go back. We've been doing it a year and a half now, so you can go back and read and listen to everything we've done over the last year and a half.
Awesome. Well, hey, Bill, I really appreciate your time and coming on Crush the Street today. Thank you.
My pleasure, Kenneth.